Hello fellow compounders. In a previous video, I reviewed a dividend growth portfolio that is paying $16,000 on a $30,000 investment. That is a 54% dividend yield. That portfolio was built 20 years ago. How would I build a dividend growth portfolio using the stocks that are available today? I'll show you my process for choosing dividend growth stocks, and I'll be building a 5-stock dividend growth portfolio. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. I know that in a previous video, I said that dividends don't matter. However, if you're planning to live off dividends when you retire, it doesn't hurt to have some dividend payers in your retirement portfolio. So I decided to build a dividend growth portfolio with 2 objectives. 1, I want a portfolio that can provide $50,000 in annual dividends when I retire. And 2, I wanted to have a yield on cost of 20% by year 20. Yield on cost means yield on my initial investment. So, in order to get there, I'm looking for companies that are growing and that make consistent profits. Without profits, it's hard for a business to pay dividends. Here's what I'm looking for in a business for the dividend growth portfolio. Number 1, 10 years of consistent dividend growth. This would give us businesses that are making money consistently. This screen is very important, since it's very difficult to pay increasing dividends over 10 consecutive years if the business isn't profitable. It is hard to fake dividends for such a long time. Some companies borrow money to pay dividends. This is a red flag. It's a very bad business practice. When you see this, run. 2, a 5-year average dividend growth rate greater than 10%. I'm looking for dividends to grow in real terms. This means they need to outpace inflation. This is critical. No sense in having a fixed dividend. For that, you should just buy a bond. 3, a dividend payout ratio less than 50%. We want to make sure that the dividend is safe and that the business is still growing. If the payout rate is too high, then there is less reinvested in the business and the business will not have much growth. 4, a return on invested capital 5-year average greater than 15%. This is the return that you will receive on the retained earnings. That is what is not paid out in dividends. Also, a steady return on invested capital is a signal that the business has a moat or competitive advantage. Number 5, current return on invested capital greater than 15%. This confirms profitability and competitive advantage. 6, a dividend yield greater than 1%. By doing a low threshold 1%, it will include growth companies that are paying dividends, which are increasing at a faster pace. On December 7, 2022, I ran this screen using stockrover.com, and I got 27 companies that passed the screen using the 6 parameters that I just mentioned. Once I had the list, I went through each of them and identified 5 businesses that I would consider buying at a reasonable price. Number 1, Microsoft. It's one of the largest software developers in the world. Everybody knows it. It's known for its Windows operating system and Microsoft Office suite. It pays a 1.1 dividend yield and has a payout ratio of 27%, giving it a lot of room to increase the dividend. The 5-year average dividend growth rate is 10.1%. It has an ROIC of around 30%, which is a sign of an excellent business. Even though the yield is very low at 1.1, I don't mind owning it because it can earn 30% return on the profit it retains. 2, Northrop Grumman, ticker NOC, a defense contractor. It provides the fuselage for the F-35 and it's building the new B-21 bomber. It pays a 1.3% dividend yield and the payout ratio is 19%, leaving a lot of room for dividend increases. The 5-year average dividend growth rate is 11.6%. Its ROIC is a healthy 21.2%. Even if they don't pay much in dividends, we know that the retained earnings are being invested at a good rate. The companies like Lockheed Martin, which is another defense contractor that I own. According to Morningstar, the fair value estimated is $368 per share, and it's currently trading at around $543. The stock looks pricey. So I would keep it on the list but put it on the back burner and wait for better prices. 3, Robert Half International, ticker RHI. It's one of the largest staffing firms in the world. It provides temporary, permanent, and project-based staffing to corporations seeking employees in the finance, accounting, and technology areas. It generates over $5 billion in annual revenue, and it currently pays a 2.3% dividend yield. It has a payout ratio of 26.8%. I like it because it has a lot of room to increase dividends. Also, since it's a service business, the ROIC is really good, coming in at 39.4%. The 5-year average dividend growth rate is 12.4%. 4. United Parcel Service, UPS. Most of us have seen the brown trucks of UPS. UPS is the largest parcel delivery company in the world. It has over 500 airplanes and 100,000 vehicles. It delivers 25 million packages per day around the world. It currently pays a 3.4% dividend with a payout ratio of 43.6%. It has grown dividends at a 12.9% annual rate over the past 5 years. It's one of those businesses that we expect to see around throughout our lifetime. As people buy more stuff online, UPS should continue to have a growing business. 5. Williams-Sonoma, ticker WSM. It's a leading retailer of cooking and home accessories. It has 175 Williams-Sonoma stores, 189 Pottery Barns, and 122 West Elm stores. It also sells B2B to large residential and commercial projects. It currently sells at a 2.8% dividend yield. It has a payout ratio of 18.2%, the lowest of the 5 stocks. This is good because it means that it has a lot of room to increase dividends. It also has a 5-year average dividend growth rate of 14.9% and a return on invested capital that is a wonderful 41.4%. At a price of $112, it's currently trading at more than 50% discount to the Morningstar's fair value estimated of $233 per share. There you have it. That's my 5-stock list for my dividend growth portfolio. Here's what I would do. I would set up a tax advantage brokerage account like an IRA or a 401k to buy the dividend growth stocks. In my case, I would use a solo 401k. I would buy $6,000 every quarter of the best priced stocks on the list. I might expand the list if the stock screen produces other interesting stocks. Right now, I would be buying Microsoft, Williams-Sonoma, Robert Half, and UPS. I would hold off on Northrop Grumman until I can get a better price. Once a stock is bought, I'm not going to be touching it until I'm ready to retire in 20 years. And I would reinvest the dividends in the most attractive stock on the list at the time. If none of the businesses on the list are attractive, I would just hold the new funds in cash while I search for other dividend growth companies.